Hey friends, welcome back to my channel. Hope all of you are doing well. In today's video, I'm going to talk about reverse mortgage. What is a reverse mortgage? It's a financial agreement in which a homeowner relinquishes equity in their home in exchange for regular payments, typically to supplement retirement income. A reverse mortgage is a mortgage loan usually secured by a residential property that enables the borrower to access the unencumbered value of the property. The loans are typically promoted to older homeowners and typically do not require monthly mortgage payments. So, why would someone use a reverse mortgage? If you are 62 or older and want money to pay off your mortgage, supplement your income, or pay for healthcare expenses, you may consider a reverse mortgage. It allows you to convert the part of the equity in your home into cash without having to sell your home or pay additional monthly bills. For example, a senior might take out a single purpose reverse mortgage to pay for property taxes or necessary home repairs. These loans are generally given at highly favorable terms like a HECM. They do not become due until the borrower moves, sells the home, or passes away. So what is the difference between mortgage and reverse mortgage? In regular mortgage, the individual pays equated monthly installments EMI to the financial institution for buying a property. However, in reverse mortgage, the senior citizen who owns a house or property but lacks a regular source of income can mortgage his property with a financial institution. How much money do you actually get from a reverse mortgage? The amount of money you can receive from a reverse mortgage generally ranges from 40 to 60% of your home's appraised value. The older you are, the more you can receive, as loan amounts are based primarily on your life expectancy and current interest rates. A reverse mortgage can allow you to continue living in your home while tapping some of your accumulated home equity. The mortgage generally doesn't have to be paid off until you die or move out of the house for 12 months or more. While that can be a good arrangement for some people, it isn't for everyone. A reverse mortgage can provide you with regular cash flow in retirement to supplement your other income, but there are some downsides worth considering. If you have a spouse, they may or may not be able to remain in home depending on whether or not they are the co-borrower. Other types of heirs will have to pay off the loan or buy home without their money. To be eligible for a reverse mortgage, your home must be one of the following: a single family home that you can occupy as your principal residence, or a 2 or 4 unit home with 1 unit then you can occupy, a U.S. Department of Housing Urban Development approved condominium project, an individual condominium unit that meets FHA requirements, a manufactured home that meets FHA requirements. In addition, your home must be paid off or largely paid off, giving you a substantial amount of equity in the home against which to borrow. Do I really need the money from a reverse mortgage? A reverse mortgage might make sense for you if your retirement expenses exceed your income from Social Security and other sources, and if you don't have much retirement savings from which to draw. Depending on whether it's a fixed or variable rate loan, an HECM can provide you with a cash in several different ways. With a fixed rate HECM, your only option is to take the money as a single lump sum. That might be useful if you face a large expense, such as medical bills, or want to use the money to pay off an existing mortgage. Adjustable rates HECMs come in other forms. Tenure: you'll receive equal monthly payments for as long as at least one borrower continues to occupy the property as their principal residence. Term: line of credit. There are also two hybrid types: modified tenure and modified term. Regular monthly payments from a tenure or term reverse mortgage could assure that you will have enough money and enough income to meet your everyday expenses, while a line of credit could be useful if you are hit with big unexpected bills. However, bear in mind that reverse mortgage is expensive in terms of FHA insurance and closing costs, and that it will gradually deplete the equity in your home over a period of time. Another option to consider would be downsizing so that your expenses are more in line with your available income. You might find that you don't need a reverse mortgage at all. Are reverse mortgages expensive? Yes, they are. The Federal Housing Administration (FHA) insurance that you must purchase to protect lender on a home equity conversion mortgage (HCCM) costs of 2% of the loan amount at the outset, plus 0.5% of the loan balance every year after that, with that balance growing year after year. In addition, there are other closing costs, including an origination fee of $2,500 to $6,000 that goes to your lender, and ongoing monthly fees of $30 or $35 charged by your loan servicer. So when is the best age to get a reverse mortgage? While you can get a reverse mortgage as early at age of 62, you'll generally qualify for higher borrowing limit if you're older. In addition, taking out a reverse mortgage later in life gives you time to build up more home equity and reduces the risk that you'll be using up all of your equity before you need it most. Now, talking about reverse mortgages and estate planning. Your home may be your most valuable asset and represent the largest portion of your estate. A reverse mortgage can help you to hang on to that asset by letting you tap into your accumulated home equity without having to sell the home. Still, the money that you can receive from the reverse mortgage will also have to be repaid after you die, reducing the value of your estate possibly substantially. If you have a reverse mortgage on your home, it will have to be paid off after you die, reducing the home's value to your heirs. The rules are different for spouses who inherit homes with reverse mortgages than other heirs. What happens to your reverse mortgage after you die? When you leave a home with a reverse mortgage to someone, you also leave them with responsibility for the mortgage. What they'll need to do next depends on their relationship to you. Reverse mortgages may be of greatest appeal to people who lack retirement accounts, non-retirement investment accounts, or adequate cash savings, making their home their only significant financial asset. For example, if you know that your heirs would like to inherit your home, drawing on those other assets for income could make them sense that running up a large balance on a reverse mortgage. On the other hand, if your heirs don't have any particular attachment to the home, borrowing against it can be a way to preserve your other assets for them. Thus, to conclude, the reverse mortgages aren't an ideal financial choice for everyone, and you may have other options such as selling your home and downsizing. Older homeowners may also consider renting it out, which alleviates home ownership headaches like property taxes and repairs. Hope you liked it. Do comment.